leader who spent over 24 years shaping corporate and investment banking across India, Singapore, and the UK. Mr. Senthil Gomathinayagam.
During the 2007-2008 financial crisis it doesn't matter how technically good your team is. When there is a crisis, leadership needs to stand.
As you said, it is a huge decision and it shows the kind of a leader you are.
What I learned is that transparency is what brings everybody together. And transparency is absolutely critical. Transparency builds resilience more than any model.
Hi everyone and welcome back to FaceTime with Leaders powered by Directors Institute World Council of Directors. I'm your host Charu Mehra and today we are stepping into a world where turnarounds are engineered, governance is lived, not laminated, and finance actually moves the needle on trust. Our guest this evening is a leader who spent over 24 years shaping corporate and investment banking across India, Singapore, and the UK, where balance sheets become strategy documents, controls become culture, and technology is more than a buzzword. From Basel III implementations and global capital reporting to liquidity transformation and machine learning innovation, he has driven outcomes at scale, centralizing 20 countries' liquidity reports, delivering double-digit process gains, strengthening first line of defense, and even optimizing capital and liquidity buffers that move in billions, not thousands. Formerly Executive Director and Global Process Manager at Standard Chartered, with prior stints at Credit Suisse and leadership roles across Treasury, Risk, ALM, and Finance. He is also advisory board member at Royal Holloway College, University of London, guiding the next gen on careers that actually work in the real world. Mr. Senthil Gomathinayagam, welcome to the show. How are you doing today, sir?
Thanks, Charu. I'm doing very good. Hope you're
That's
doing well.
good. I'm doing good as well. So, Mr. Senthil, the resume says finance, treasury, risk, change management, but every great resume hides an even better story. Would you take us back to the beginning and walk us through your journey in your own words? One or two moments that changed your arc, a challenge that humbled you, and one decision you still stand by today.
Sure. If there is a buzzword, it'll be from biochemistry to banking boardroom. My career has been anything but linear, right? My resume may read finance, treasury, risk, and change management, but behind every resume, as you said, lies a different story, different challenges, and different turning points. Mine began, far from balance sheet and Basel regulations and different products and trading flows. I actually started out as a science graduate in biochemistry from Royal Holloway, University of London. Armed with 2 masters, I entered Merrill Lynch in London, where I joined a small treasury team managing medium-term funding, structured debt finance, liquidity, and interest rate risk. But not just in UK, but across EMEA, which is Europe, Middle East, and Africa. That was my first actual taste of the financial world. And it set me on a path that would span 25 years across multiple geographies and plethora of roles, technical expertise, transformation leadership as well. And in Standard Chartered Bank, my career started off in Chennai, where I built a new ALM team, asset liability management team, where we were centralizing and standardizing and automating liquidity and interest rate risk reports. And as you said, as part of the introduction, it was across 20 different countries. Later, I moved across into Singapore, joined Group Portfolio Risk, which is a very unique team, which is basically a think tank team for the group board risk committee and credit committees.
Okay.
Then from there, I kind of moved on to a different spin. I've been in the line role and in the front office for so long. I wanted to get an experience of running a project and running a strategic initiatives. So I started off on a journey of standardizing the asset liability committee reporting process across SEB jurisdictions, so that you have consistent decisions and MI, so you can have a global, regional, country level decisions, which are all coherent.
Right.
That success opened the door for me to get into Basel III implementation, where I designed governance, and a number of data quality issue remediations and so on.
Right.
From there, I moved into more leadership roles in Credit Suisse and Standard Chartered, which eventually led me to develop the Center of Excellence in Standard Chartered Bank for liquidity, which we've very quickly expanded to cover capital, regulatory reporting, interest rate risk. So we had the full balance sheet coverage from an operational perspective set up centrally in India. I
Wow.
think we were one of the first banks to ever do that.
Right.
And I took on a much more leadership role across all of this area. So we basically managed the group's balance sheet operations across finance and risk.
Okay.
So from there, I kind of grew, the role got bigger and bigger, and I just organically evolved in there. But as you said, my resume only tells half the story. So what was my actual turning points in my career? So to me, the turning points comes when you have to take a risk. My first turning point came back in 2001, very early on in my career, just as I was in Merrill Lynch. We had the dot-com bubble burst. And there was a whole upheaval in the London markets, in the investment banking world globally, and in UK as well.
Right.
So I decided to leave London, take a credit risk role in Glasgow in Scotland with Royal Bank of Scotland. And all of my ex-colleagues, my friends all thought I was crazy. I said, you're taking a very much a backward step because everybody wants to get into the city, want to be in the investment banking on the front line. But here I am being there, now taking a step back. But it just felt right. And in reality, what happened was it gave me much wider understanding of what banking is, not just investment banking, but commercial banking. So I gained, hands-on knowledge across both retail banking segments, covering things like developing retail scorecards, launching retail products. In fact, I was kind of the perpetrator for launching this 7 and 10-year unsecured loans for RBS at that time. The first bank in UK to do it. So I led the credit risk function for that, and then the marketing team took over and we launched it together.
Right.
So later on in my career, when I actually came into the leadership roles, I could actually understand the terminologies, the nuances of retail banking, even though I was always wearing an investment banking hat on. So that was very unique. And, it was kind of sought after, people talk the whole landscape. The second major change was my move from London to Chennai. I was leaving a front office Treasury role right bang in the financial crisis in 2008. And I took up a back office build out in India. And again, everybody thought that was a massive downgrade. And to be honest, when I first joined in Chennai, I did not like the work. I hated it. The bureaucracy, the frustration, and the pace was just too slow. And it took me a long time to get used to it. But in a space of about 18 months, we managed to do about 20 countries migration and centralization. And that's the speed I was willing to run at. And what happened was, as I was kind of clearly setting out my goals and my aspiration and driving this forward, that kind of energy, that kind of impetus actually started feeding downstream to other teams who were sitting around me. So now they started becoming a lot more professional, not accepting the fact that, if there is an IT issue, we can wait till for the next day to get it fixed. They would put pressure on other teams. So that, stagnant inertia slowly started evolving. And it got noticed not just within the Chennai space, but it was noticed across the group because they could see things getting delivered faster, less errors. So it kind of led me to different opportunities and more strategic leadership roles in market risk function. So very quickly from setting up the ALM team, I began to run the whole market risk function in Chennai across all the footprints. 30, 40 country footprints, and I was centrally leading all the market risk functions and the MI production. So if there's any lesson, which I can kind of partake in deliver to the audience here is never fear stepping into the unknown. As long as there is scope for you to learn and grow, never ever hesitate in jumping headfirst into it. But you got to work smart. You got to focus on results. It's not about just keep doing things. You got to focus on results. And there's only three things any corporate or financial institute cares about. One is cost reduction. Second is risk mitigation. Third is revenue generation. If you can impact at least one of those in your early part of your career, you will go places. And that will create an impact that lasts.
Wow.
Hope that answers your question.
Wow. Yeah, I was just saying, that was beautifully raw, Mr. Senthil. And I think everyone listening can see not just the resume, but the person behind it. To actually taking a step back, as you said, it is a huge decision and it shows the kind of a leader you are. And it's also fascinating how you brought out the very human side of decision making. So kudos on those decisions and overcoming the challenges that you face. Thank you so much for sharing your journey with us.
My pleasure.
When you moved into Global Process Manager remit at Standard Chartered, you took on capital and liquidity reporting at a serious scale. Budgets, global teams, moving parts, and regulators watching closely. Walk us through your first 90 days. What were the spiciest calls to stabilize and speed up? Centralization, one LOD controls, automation, PRA remediation. How did you bring about partners and team along?
Thanks, Charu. So when I stepped into the global process manager role at Standard Chartered Bank, it wasn't a big grand design that I wanted to become a GPM. It was kind of an organic progression from implementing the Basel III solution for liquidity and then taking over the kind of the BAU function to make sure we have smooth operations for regulatory reporting. So the natural step was to centralize all the liquidity reporting and MI production into one place. Now, since I've already done that with market risk, it was natural for me to, senior management said, well, look, you've been there, you've done that, you got the T-shirt, so go get another T-shirt, basically. So they gave me the role and I said, okay, fine. I accepted it. So what did I do in my first 3 months, 90 days? I primarily focused on three things. Lessons learned from my previous experiences and lessons learned from seeing other projects being delivered across the bank and across other banks as well. The first thing I looked at was governance. So too often, banks and corporates rush in to deploy technology solutions and leave process controls and accountabilities for the process for much later. And that cascades into a pretty much a mess, right? And you end up unraveling it over many, many years. So I wanted to reverse that. So my first priority was to put in place a robust process controls, governance, define roles and responsibilities in parallel with the technology delivery. So as the technology solution delivered, people knew how to use it, who needed to do what, and what are the risks covered and not covered. And people, and everybody had that visibility. My second priority was building the right team. No process or technology it's only as good as the people who are running it.
Agreed.
So I built a very strong team with strong individuals with the right skills. When I say, when you normally say, strong skills or strong team, people always think about seniority. It wasn't about seniority. I really didn't focus on looking for people with experience. I kind of tested them out in bringing in people with the right skill set, the right knowledge of risk. It doesn't have to be about liquidity, but if you had a quantitative experience or quantitative mindset, you're in. So, and most important for me was to build people with curiosity and hunger to learn and grow. But above all of that, they had to have integrity, right? They don't backstab each other to get to the top. So those were the kind of characteristics we were looking for. And it took a bit of time to build it, right? Build that kind of team. But we didn't build a very big team to start with. There was about 15 people. And there it evolved into a much, much larger function. Because what I've seen through my career, especially during the 2007, 2008 financial crisis, is it doesn't matter how technically good your team is. When there is a crisis, leadership needs to stand.
Right.
And people who have that kind of mindset are the people that we are wanted to have in the team. Because we know regulatory reporting, something is going to go wrong. And we need people to just put their hand up and say, well, you know what, I'll get this sorted for you. And the third thing that I really focused on was detailed process study. So identified data issues and operational issues, and we tracked them for remediation and ongoing maintenance through KPIs.
Right.
And these KPIs were directly linked to cost, risk, and process time reduction.
Right.
So we had set targets that, if you were doing a part of a process and it's taking an hour to do, what kind of automation are you going to do to reduce that? And that was shown as a KPI. So over a period of months, you can see it's going from 60 minutes to 55 minutes. Then suddenly it just disappears because we fully automated it.
Wow.
So we could track it as a real-time KPI. Well, monthly
Right.
KPI. So what happened was with these kind of linkages, it became a very powerful tool. It showed how fixing operational issues and data issues could actually reduce the liquidity and capital buffers that we were holding up.
Right.
Now, what that meant was if we were able to reduce those capital buffers, you're freeing up the balance sheet for revenue generation. And selling that with a clear remediation plan to senior management was a no-brainer.
Right.
They completely jumped at it. And once we had that support, we took it to the businesses. And businesses were like, oh, how can we? It wasn't a case of, can you help us drive this? It was more about, they were coming to me and goes, what do you need to get this done faster?
Wow.
Right? Do you need us to kick somebody in our technology function or in our risk function or in our operations function? Or, what do we need? Do we need to train the RMs, the traders, to book trades in a consistent way? So all of this became the whole script just flipped without us.
Right.
We were becoming the kingpins on all of this. So that, I think, was the most important thing, that you make the remediation plans and the solution tangible so people in the other side of the world, on the other side of the desk, can understand it. Once they do, then you're on a winner.
Wow. That's proper 90-day roller coaster, the uncertainty, turbulence, and then the stability. And what stood out to me was how you frame centralization, like, conducting an orchestra, everyone coming together, working together, and creating a beautiful symphony. So that's really wonderful. And thank you for sharing that with us.
Thank you, Cheryl.
So you've been revamping operations while pushing tech, ML, decommissioning legacy, Basel 3.1 upgrades. How do you design a model where efficiency, risk integrity, and regulatory outcomes show up inside the P&L and not just in policy decks?
So the banking industry often treats efficiency and regulatory integrity as a trade-off. And when I think about transformation, whether it's machine learning or decommissioning of some legacy platforms or even regulatory upgrades like Basel 3 or Basel 3.1 upgrades, my focus has always been on making sure that the outcomes don't just become theoretical and sit on a desk.
Right.
But they actually show up on real terms on a P&L benefit or freeing up balance sheets. So the way I approach it is very simple. So every initiative that crosses my desk has to tie back to one of the three levers. One, cost reduction. Two, it has to have an optimization of risk-weighted assets. Third, it has to be an enabler for revenue generation. If it's not hitting one of those three pillars, what's the point of doing it?
Agreed.
Right? Just don't do the task for the sake of doing it. So, for example, when we automated the liquidity and capital reporting, it wasn't just about accuracy or speed. Yes, it reduced manual effort, it lowered operational risk, and freed up the capital buffers that were previously locked up because of process issues or data issues. But what it actually did do was, once we remediated it, it released those buffers to release capacity, to increase the capacity for growth. And that was a direct P&L impact. Now, when we were proposing all of this, the Treasury desk or the trading desks for the financial markets trading desk were a little skeptical. But once we started showing removal of significant amount of manual adjustments, I mean, I'm not talking in thousands, I'm talking in billions here.
Billions.
Then they said, well, look, if you're taking off of this amount of manual adjustments and for data issues because you resolved it, well, I don't need to hold that buffer. I can take 75% of that buffer and I do something with it.
Right.
Suddenly, their revenue started increasing, right? And then the second example I would say is embedding controls into the process itself. Like I said earlier, too often governance is bolted on at the end of a process.
Agreed.
But what I did do was, as part of the first line of defense, I integrated with my team, we integrated data quality checks as part of the regulatory compliance workflow from day one. So I insisted I needed to know how every single critical data point was flowing through into my final returns. Thereby, if there is an issue at the source, I know, what the potential impact would be. Or if there is an issue within the process itself, we'll be able to capture it.
Right.
So that way, what we built was a risk integrity in parallel track. And it's part of how a process should run on a daily basis.
Right.
Third item really was technology of choice. It has to be, whatever technology solution you bring in has to have a measurable outcome. We just don't want to deploy machine learning because it's fashionable, right? We deploy it because it reduces false positives, speeds up reconciliation, and shortens reporting timelines.
Right.
I mean, for example, I'll give you one of the solutions that we implemented was a reconciliation on a daily basis for all entities on derivatives transactions, from source to report. Wow. And it was against GL against a GL as well. Doing something like that was never feasible if we didn't have a machine learning. I mean, to do something like that, it would take a week.
Agreed.
1 day's activity. The machine learning solution provided that analysis in 12 minutes.
Wow.
All right. So what it meant was the output we were giving was that much more accurate. It was more precise. And it led to much more deeper understanding of how the data is being treated within the regulatory space. And then the nuances started coming out, right, on the treatment of different derivative products, for example. So, and again, a similar experience in decommissioning legacy systems. It's not about just IT saves. It's about reducing the operational complexity.
Right.
The legacy data warehouses, which just have pass-through data. Well, why have it? You're running a process which has zero value add. Get rid of it. Cut down on run times, processing times, cut down on technology spent, and remediation activities as well when there's a global change.
Right.
So from all of this, what I learned is that transparency is what brings everybody together. By presenting outcomes in terms of cost save, risk reduction, or balance sheet remediation, or balance sheet growth, capital release, you can much more easily align senior management, regulators, auditors, and the businesses, and we can keep them on the same page. Yes, there will be friction between them. I mean, it's not going to be a perfect picture, but at least we get the global picture.
Agreed.
Right? That's how you bring in efficiency, risk integrity, and compliance. And that's how the whole thing doesn't just become an abstract on a whiteboard, and you start bringing tangible results, which impacts your revenue and your P&L and the organization.
Agreed. And I also believe that risk and efficiency are kind of a paradox, both sides pull in opposite directions.
Absolutely.
And the way you manage that, the way you describe the successes, it feels so much more real. So thank you for sharing that with us.
Pleasure.
So in the fintech era, speed is a flex until it isn't. Where do leaders go wrong scaling tech? And how do you make sure such tech reinforces governance instead of automating a bad process?
So in fintech, speed is often celebrated as a flex, but speed without discipline can be dangerous. Too many leaders confuse shipping fast with scaling right.
Right.
And I've seen it happen so many times. And what happens? They end up automating broken processes and lifting inefficiencies straight from an old box into a new box.
Right.
It's like driving a sports car on a bad road. The faster you go, the harder you feel the bumps. You got to smooth that road first.
Right.
So I've seen it in firsthand. Early in my career, there was a rushed automation rollout that looked like acceleration on the surface. But instead of solving problems, it multiplied into data mismatches, reconciliation breaks, and it created downstream chaos. People didn't understand what the data was and how it's getting, what the interplay was. And obviously, the regulators picked up on it, and they came down pretty hard on it. That experience taught me a simple truth. Speed is, if it's not anchored in governance, doesn't reduce risk. It amplifies it. So it has to have a coherent, risk-based approach when you're implementing any technology or fintech solutions.
Right.
So what's my approach? It's always been to flip the script, right? Like I said earlier, governance first, then technology. Before automating anything, I re-examine the process, put in place clear controls, and define R&Rs. Only then do we apply the tech. So the tech fits to the process. You don't redesign the process to fit the tech.
Fix the tech.
Right? So for example, when we were doing Basel upgrades, we embedded controls upfront, so compliance was built into the workflow. And we deployed machine learning. It wasn't, like I said, it wasn't because it was popular. It was because it reduced the reduced data bias in risk reviews and improved quality.
Right.
We could have gone one step further and implemented AI, because that was just an extension of the same tool that we were using. But I did not want to do that because I don't think we were mature enough at that stage to really understand how an AI bot would help in this process.
Right.
I think it would have caused more chaos than anything else. So, of course, these kind of approaches isn't always popular. I mean, when I refused to adopt the AI approach, I wasn't a very popular person in the bank, okay? Teams will push back. There's always a quote, why are you slowing us down?
Right.
So I had moments where we had strong resistance, which literally derailed the progress. But what turned it around was transparency. Proving value through small pilots, showing buy-in from auditors and regulators, not being worried or scared about going and talking to auditors and saying, you know what, I have this solution. Do you think this is fit for purpose?
Right.
Do you think this passes a regulatory audit? Does it tick all the boxes that you need to have, in terms of governance, controls, whatever metrics you want to go by? And what happened was they quickly became partners. Internal auditors became very strong partners. Any solution we have prototypes on, they will just come and give an opinion on it.
Wow.
Instead of becoming a roadblock,
Yes.
And what happened was, by having the first line, which is your, the risk managers, then you have the second line, and then the third line is your auditors, having a coordination between the three, it actually demonstrated how governance should actually work.
Right.
And that coherence between the three lines of defense actually freed up capacity and reduced the actual, to and fro of work.
Right.
And once people saw the benefit, they bought in. So the larger lesson was really speed without governance is reckless. But at the same time, governance without speed is paralysis.
Wow.
Right? The art of leadership is designing systems where both coexist. Where technology accelerates, but within guardrails that protect integrity. That's process integrity, data integrity, and risk integrity. That's when transformation delivers real payoff. And then we have the trust from the customers, from the regulators, and you see the tangible benefits on our balance sheet. Right.
That image that you built of speed being a flex until it isn't, that's going to stay with me. And I really like how you flip the narrative. You said it, and tech as an amplifier, which can either magnify mistakes or multiply its value. So thank you for sharing that with us, and kudos for that wonderful success.
Thank you.
All right. Moving on to the next one. Quick hits, no overthinking. Ready?
Ready.
Okay,
Fire
first
away.
one. Tea or coffee?
Coffee.
Coffee. Filter coffee or normal coffee?
Filter coffee.
Filter coffee. This was mine. This is not a part of. This is just an impromptu that I put up. Okay. Early bird or night owl?
Early bird.
Early bird.
Working
All
on the
right.
trading floor, you can't be a night owl.
Okay, next one. One buzzword you'd ban forever.
Low hanging fruit. I hate it with a passion. If it's low hanging fruit, get it fixed. What are you talking about?
Absolutely. Okay, next one. Comfort food after a long day.
You're going to laugh at this one. Fish and chips and creme brulee.
Oh, wow.
Weird combination, but
Okay, next one. Alternate career you'd have chosen.
biomed, probably research,
Wow.
with my biochemistry background.
I was really surprised from biochemistry to banking. It's entirely different.
There's a different story to that. That's for another day.
Okay, next one. A movie or a show you never get tired of.
Star Wars. Star Wars fan for life.
All right. A funny habit your team teases you about.
Twirling my head. I sit there just doing this, right? And I get teased a lot.
That's a unexpected one. All right,
Or I
next.
pace. That's the other one. I pace the office up and down.
Okay,
So
that's
they
good.
know,
You
people
complete
know
your
that
steps.
exactly. If I'm walking up and down or behind my desk, people know, right? Leave them alone.
Okay, next one. Past or future, where would you time travel?
Future.
Future.
How is AI actually going to make a difference?
Absolutely. That is one thing which I think about all the time. Okay, last one. 3 words to describe yourself.
I don't know about 3 words. 2 words is stoic visionary.
Wow, that's really wonderful. That was really wonderful rapid fire round, crisp and chaotic in the best way. And I really like doing this because it gets to, you get to know the person behind the professional. So that's really interesting.
Absolutely.
So we've seen how operational risks shows up, data lineage gaps, model misuse, access creeps, process workarounds under deadline pressure. From your playbook, what are the non-negotiables to prevent incidents, and how do you make sure controls are lived, not laminated?
I still remember a Friday afternoon in Singapore. I stepped out for quite a rare team lunch, and as fate would have it, phone started buzzing. And I initially saw one message, and then it was just like stream of messages coming in. And so I had to rush back into the office. So there was a data issue tied to a legal entity program that I was a head of for APAC. And as part of the initiative, the APAC regional collateral was being decentralized from London, where Singapore was designated as a central hub. And I was the APAC head of Treasury projects, and I was leading that. We did all the testing, everything for months in advance. We even initially did a $5 billion transfer of collateral. Everything was smooth.
Right.
And so we went for the big tranche. I think it was about $35 to $40 billion, one shot rebooking from London to Singapore. And as fate would have it, it didn't work. So on that Friday, it was a final handover before the whole thing was supposed to be closed out, and the entire data flow collapsed.
Oh my God.
So in those kind of moments, you got everybody screaming at you and nobody knows what is going on. You don't have time to think about frameworks and policies and approvals and all of that kind of things, right?
Right.
So you think about how quickly can you find the crack? Where is the issue? How do you contain it? And then how do you move forward and then explain it to to senior management and to others you need support from?
Right.
That is when operational risk feels real. Until then, nobody will pay attention to operational risk. You say processing time, operational breaks, they're like, yeah, whatever, right? We got enough buffers, you got enough limits to manage that. But when something like this happens, whole panic sets in, and then they go, right, why did we not pick it up in operational risk controls?
Right.
So what do you do? So these kind of experiences have shaped, as you said, my non-negotiables. So for me, every number must be tracked back to source. So the quality of the data is absolutely critical. So, when I was running the Treasury funding desk for Sydney, Shanghai, and then supporting Singapore, I always focused on data. Okay, you do trading decisions and funding, transactions, but the quality of the data was critical for me. And I was one of the very few, I was in the very small minority group who actually sat in the front office, cared about data. And I used to get criticized a lot. It was like, why do you keep going on about data? When you're looking for hedging and all the different strategies, when sitting on the Treasury side, they're saying, how do you know that is correct? Who has proven to me that this is the right value?
Right.
And they used to get annoyed with me, but I didn't relent. Because understanding the data flow, the usage of data, either through data mapping or data lineage, is absolutely critical, and it's not an option for me. It has to be a deal.
Right.
Second aspect is really about access to system, access to data, and even access to the flows that people are working in. Because if you're in the front office, for example, you cannot have anybody waltzing through the door.
Agreed.
So you have to have the right privilege to be having access to those information. That has to be enforced, and it can't be enforced manually. It has to be enforced automatically. So you have proper system enforced controls, access rights being governed and tracked, and access creep is absolutely critical, especially when people move around in a large organization, right? They're moving from one role to the other, but they should have, access is revoked, which they shouldn't have in their new role. So all of that, I've seen the bad side of all of that, so not a compromise for me. The third item is really about the quantitative models, the financial models that we use. A lot of times, especially around these new ESG world and the fintech type solutions, we compromise on the integrity of the model for speed or accuracy of whatever macro level issues that you're trying to deal with. To me, models need to be approved, needs to be tested regularly, validated by a forum, and you need to know the breaking points of each model, the risks that are being covered, and the blind spots that were made. And every single change, however small, however big, has to be documented and tested properly. Without that, you should never go live. And I've seen, regulatory compliance models being approved and gone live, and we submitted to the regulators and had to pull back. All right, it's a huge reputational damage. You completely lose the integrity of the whole organization. So, that absolutely no compromise.
Right.
The final part I would say is you need to have a playbook. Playbook from a business perspective on the crisis, how you deal with who needs to step up, who needs to do what. A lot of organizations will have these war rooms, but those war rooms need to be tested on a periodic basis. Technology needs to have a playbook on system go live and have the ability to roll back rapidly without impacting business and BAU.
Right.
So all of this, you cannot have people just improvising on the fly. You have to have a proper playbook, accountability, who needs to do what under this kind of crisis, and absolutely critical. So for me, controls needs to be embedded as part of the culture. I've seen it happen where they're just treated as paperwork. I mean, even when I started off in my career in in UK after Merrill Lynch and RBS, other banks, controls was always like, yeah, we'll get to that, And even, later on in my career, I enforced the fact that it has to be in your day-to-day life. You have to live and breathe controls. So it has to be embedded into your daily workflow. For example, we replaced manual reconciliation with automated pipelines that alert the data owning team of the issues, and it blocks downstream actions until that issue is fixed. So people don't react and don't go and take unnecessary actions without really understanding what the problem is. So we built, dashboards. We use technology to build dashboards and to show control effectiveness in real time. But that wasn't just enough. We had, I insisted that we have an operational risk team come and do an independent review of all our controls on a periodic basis. People who don't understand our process. So that way we identify where are the bottlenecks in the process. People running it daily will automatically run through it. Somebody new for a pair of eyes will spot things, and look at it differently.
Agreed.
So on a quarterly basis, we used to have an independent testing of every control across our process. And that the testing of that is published to a very senior forum. And it's shown as KPIs and in various dashboards and so on. But the most difficult part is embedding culture, right? Controls into your culture, governance into your culture. So under any deadline pressure, people attempt to work around controls, right? I had to face this many times. The way you had to run through it was, you need to align so that people are doing the right thing, not always the fastest thing. That takes training. That takes courage. Because it always, more often than not, it's not about you or your team. It's about somebody else upstream or somebody else around you. And you got to go and step up and have that hard conversation with them. But as a leader, that's your responsibility. You can't just shy away from that. Right? So this is where you have these drills, like in, if you're flying a plane, you have a list. The pilot has a list called the cockpit list. Then if you have a hospital, emergency, you have a hospital drill. In crisis. So in those situations, people need to immediately get into crisis mode. So when I take all of these things to the board, and I explain to board risk committees or exec committees, we don't talk about controls as an abstract item. We translate it into outcomes. What incidences we avoided, how many issues we fixed, did we avoid a fine? Did we reduce our operational losses? Did we close our books faster? Did we reduce our manual cost of those work? Make it a tangible metric so that it becomes real for non-operational people, risk managers, business leads, business heads, and your CFO, CEOs, and all of those guys. It becomes real to them. So what I have learned is very simple. Controls isn't a tax. Done well, they're an engine for resilience, credibility with internal and external parties, and it gives you predictable economics. That's what gives both business and stakeholders confidence in what you do. So controls should be your lifeline, should be your oxygen, basically.
That opening scene that you talked about when you were out on lunch, that made, I felt that I was there, and
I never got my lunch that day, by the way.
Also, the way you turn and act, a near miss into a living control program shows the difference between policies and practice. So kudos on that wing, and thank you for sharing that with us.
Pleasure.
Okay. So you've been engaging with communities like Directors Institute to push boardroom excellence. What pulled you in, and how has that shaped your view of modern governance?
So what pulled me into communities like, the Directors Institute, it was simple. It was just simple truth. Most of the failures that we've seen in the banking world weren't because of broken models or missing data. They were about weak oversight in the boardroom. I realized that, in the conversations I had within the businesses, and then when I went and presented or was sitting in the boardroom, two different things.
Right.
And very quickly realized that the conversation had to move from the business line into the boardroom, and people needed to start, the board of directors needed to start understanding speak the same language.
Right.
So if the boards are not asking the right questions about tech disruption or ESG or regulation, then no amount of operational excellence or risk governance is going to make a difference. It's not going to save you.
Agreed.
So what I found was eye-opening. There wasn't a polite, seminars. There were raw debates. For example, in one session, regulatory reporting felt like peeling a puzzle. How do you measure what truly matters? Another discussion on governance blind spots reminded me of operational misses I lived through. It's like when I was working in the group portfolio risk and we had to face off the group, board risk directors for risk and credit. We used to get weird and wonderful requests. I mean, I remember the most weirdest one I had was what would happen if Israel retaliated against Iran and Iraq. Iran retaliated against Israel and caused a financial crisis, Middle East oil crisis. Can you tell me what is the probability that Iran missiles would be able to reach Tel Aviv? And I was sitting there going, when did I become a military expert here? I'm a finance guy. I'm a banker. So I had to go back, and I can't tell that to the board risk committee, right? So I had to go back and make a real assessment on what is the probability of Iran being able to hit Israel with a nuclear weapon.
Right.
Those are the kind of unique things that comes up. But what I realized in all of these kind of various experiences that I have is, like I said earlier, controls needs to be a part of our operational culture.
Right.
And transparency is absolutely critical. Transparency builds resilience more than any model, any stress testing. You become open, you become clarity in your explanation and your business dealings. It'll go a long way. For instance, when I was working in London, we had launch a new product called at that time it was called the US leverage loans, US dollar leverage loans. The initial framing for senior management review was all about compliance, making sure the disclosures were correct, and we had all the approvals and so on, all ticked off. But when I took it to the board risk committee, we didn't talk about compliance risk. I kind of anchored the decision into building customer trust and long-term credibility. That shift and that conversation immediately created a safe haven for people to think, can we actually make money on this kind of stuff?
Right.
Without increasing our risk appetite. Then it went on to very quickly diverted into, can we launch this safely and how quickly can we do this? So, over a period of time, what I began to understand is the fact that you have to have clarity in what you're doing and explaining things in a very simplistic way to the board so that they can understand it. Then you build on the complexity layer by layer. It's like, building a cake. You put the foundation, then you put all the icings on the top. At times it feels like the movie Big Shot, where the warning signs are visible, but the consensus is very slow. But you got to be patient. You have to be persistent, and you have to be courageous. Right. Sometimes you have to go against the tide. And the big lesson I carried with me is, the modern governance isn't a checklist; it's a foresight. It's like a lighthouse guiding a ship through disruption. So if it's embedding ESG into your strategy, treating reputation as a capital, making ethics as a driver of growth, not as a drag on it. Right. And being part of communities like Directors Institute has sharpened my belief on how governance isn't a meeting. It's a living culture that has to be demonstrated every single day. Agreed. And it aligns both the functional, technical, and the board together.
Wow, that was such an honest window into why community governance communities matters. It's not policy, it's purpose. And
Right.
I like how you framed governance as a living culture, not just a meeting. That's a reframe boards everywhere needs. So thank you for that, and I wish you all the best for the goals that you've set for yourself. And thank you for sharing your journey with us, sharing your learnings with us.
Thank you, Charu.
All right. So thank Mr. Senthil, thank you for bringing the real talk where liquidity meets leadership and where control and culture scale together. From APAC Treasury pivots to Basel Studio to ML modernization and people first execution. Your story shows how clarity and discipline can unlock performance without losing the plot. To our listeners, if today's convo did its job, you'll walk back into your next review asking better questions about lineage, control ROI, and culture as a risk mitigant. This has been FaceTime with Leaders, powered by Directors Institute World Council of Directors. I'm Charu Mehra. Until next time, keep shipping, keep learning, and lead with purpose. Thank you.